Okay, so hello everyone. Welcome to this weekend edition of the Macro Snapshot. Just for the record, I'm recording this on Sunday, February the 2nd, about 3:30 p.m. So 2 to 3 hours before the cash market opens and the futures markets opens. Obviously, the point of this is just to have a look at where we could open and what the implications are of the confirmation that Trump will has signed into law, actually, 25% tariffs on Canada and Mexico, with the exclusion only on 10% for energy coming out of Canada, and then for China, 10%. And then he just said in some kind of press conference, he said that most probably on Europe as well. So let's just have a look and see what's going on, look at a few charts and everything. One thing I will say, which is kind of interesting, just in thinking about the FX, is that technically they don't come into effect, like legal effect, until 12:01. So it's basically midnight of February the 4th, which is Tuesday. So this evening is going to be interesting, and then tomorrow is going to be interesting because although Trump has signed the law and it's sort of official, they don't actually officially take place become law until midnight on Monday, so tomorrow. So what that means is that in theory, there's still, kind of like one day, 24 hours for negotiation. And that's interesting because at a certain point, let's say for things like sort of the Mexican peso or the Canadian dollar, it suddenly becomes kind of an interesting risk of if they aren't imposed or there's some kind of negotiation at the 11th hour, those currencies are going to really reverse. But I think that the general thing to take away here is that for sure this feels like a risk-on move globally, just because anytime we've had tariffs and trade wars, this is not good for risk sentiment. And we've already seen out of Canada that Justin Trudeau, who of course is very weak because he's essentially resigning as Canadian Prime Minister. So I don't know how solid that's going to be. But anyway, Canada has decided to impose on its side sort of tariffs as well. So the minimum we could say, if we just look at Canada, is that there is a tit for tat situation going on. And you have to say, obviously, the US economy is a much, much bigger economy than Canada. And so things are not looking great in theory for the Canadian economy in terms of a recession building and jobs being lost and whatnot, which of course, in theory, should be pretty bad for the Canadian dollar, which we'll get to. So risk on kind of tone. It could be that for the bond market, is this going to be some kind of steepener situation here if we start thinking about less growth, the possibility that we have to start thinking about the Fed maybe thinking about potentially needing to sort of cut interest rates sooner than they would like. And I just want to put this in mind of thinking about it, guys. Kind of interesting reading some commentary and thinking about it is this idea that if the idea is that the global economy and the US economy might actually have less growth, could this sort of change the way we start looking at data? Now, what I mean by that is that, for example, we've had a lot of sort of consumer inflation, and I think it's fair to say that a lot of CEOs have reported that consumers are really not able to absorb too many sort of more price hikes. They can't pay too much more. So then we get to a situation where maybe companies, instead of sort of pricing in or sort of passing on price increases to consumers of 100% or the 25% or whatever, they might have to sort of eat some of that, and their profit margins might be eaten into a little bit. So we could get a situation where companies their profit margins are decreasing a little bit. We obviously still have this whole issue about the deep seek for certain companies, and we have more trade tariffs, supply chain disruptions, and also potentially a lower growth situation. The other issue as well is that if we start getting some kind of steepener in the bond market, like a the front end sort of yields coming down more compared to the back end yields, the steepener could lead to a situation where the multipliers, in terms of the stock valuations, become less and less attractive. So we have a problem of growth problem for stocks, and maybe the multipliers really being overvalued. So we have a valuation and a growth problem in stocks. And so it's not looking, it could be a sort of a potential sort of sell-off for the stocks coming up at some point. And what I wanted to say about the data as well is that imagine a scenario where maybe the market's now thinking that all data which comes in, for example, we have JOLTS coming in this week, we have the ISM surveys, and we have, of course, non-farm payrolls at the end of this week. What happens if the market starts sort of discounting or ignoring all of that and saying, hey, that's kind of old news we know about? What the market will start discounting and pricing in is the relatively quick slowdown in economic performance. And so suddenly this data becomes less sort of interesting. And maybe the market actually starts pricing in more this idea of, more FOMC cuts. So definitely it's maybe not a bad time to start looking at what's priced in terms of the FOMC. And maybe we'll start there. Let's have a quick look and just go to that. Sorry, guys, I'm just opening everything up here Sunday afternoon. A little bit unusual. So we'll just go to the see what's priced in here. So as you can see, this is for the US, and what we can see here is that for the year we have about 1.8 cuts. I think there's a good chance that definitely goes up to 2, even maybe 2.5 or 3 relatively quickly. Even if especially if we start getting weak data. So imagine what the market's going to be looking for now. If we get solid data, the market may be tempted to ignore it and say, well, hey, that's sort of old news priced in. We're interested in the forward path of economic growth and the multipliers. But what happens if we start to see any sign, any suggestion of a slowdown, maybe a worsening employment rate or any sort of slowdown in earnings or sort of real economy data? I think this 1.8 cuts, where are we? 1.8 cuts. I think that could go to 2, 2.5, or even 3 relatively quickly. So very interesting to see how the market's going to start interpreting data. That's my point. Okay, so a couple of things to be looking out for as well is that we have the QRA, the quarterly refunding announcement. Basically, we're going to get sort of the overall number on Monday. But really, I think what's going to get the market's attention is on Wednesday morning at 8:30, because that's when the Treasury will or will not announce either more size overall, but they also announce the composition. So this mixture of bills, the short-term bonds, or the short-term bills, and the long-term coupons, like the 10 and the 30-year. And what I want you guys to keep in mind, which is super important, is that Yellen, probably politically motivated, I want you guys to look at long-term here. So let's look at let's say the SPX, and I want to go all the way back to the last time, the major change in the QRA. Now, you're going to remember that on Wednesday, the 1st of November, which is right down here, what do you guys notice? You can notice that essentially was the beginning of this very, very serious bull run in the stock market, in the equities. And basically what happened there, to simplify a little bit, is that Yellen decided that she would issue less 10 and 30-year bonds with the coupons and would sort of front load most of the debt issuance in the US. Now, because she did that, so basically, historically, she changed the ratio of short-term bills. So I'm talking, like 1 month, 2 months, 3 months, 6 months kind of bills compared to, let's say, 10-year bonds and 30-year bonds. And she issued a lot less of those long-term bonds. And basically, the market is very sensitive to that. And so the market liked that, saying, hey, there's not that many long-term bonds being issued. So therefore, that was artificially suppressing the long-term interest rates, which is taken by the equity market, which you see here as a positive, and a positive for risk on in general for all asset classes. So we had a huge, giant sort of run up. Was that politically motivated? Maybe. But the point here, guys, is that Scott Bessent, who is the new Treasury Secretary, he's on record as saying that they need to get back to the traditional sort of mix of terming out. Basically, they need to start issuing more and like a historically more regular sort of quantity of long-term bonds. And if that is the case, we now suddenly have a situation. That information we will get on Wednesday. Now, if that is actually confirmed by the Treasury, we not only have this whole risk-off problem of tariffs, we'll get the double whammy, the double problem, the double punch of extra long-term bonds suddenly coming into the market. And I don't think the equity market will like that at all. And I'm not suggesting that we're going to have some sort of crazy sell-off here, some kind of going back here to P1 and a 33% sell-off. But I think there's significant chance if the tariffs are confirmed and indeed Trump doesn't, make any compromises, and if, number 2, on the Wednesday, we get more long-term coupon issuance, so more 10-year and 30-year bonds. If that's the case, I think we could enter into a pretty nasty correction. And I think some of the levels here, we're looking at maybe like 58, 65-ish, something like that. Here's the first kind of level down here on the SPX. And then I'd say even further, it could be 56, 75, something like that on the cash. You'd have to kind of check that out on the futures, on the ES, but on the cash. So you've got these sort of levels there, as I say, about 58, 65, and looking at it here about 56, 70, 56, 75. 2025. So very important to see whether that's going to happen on Wednesday. Now, will he do that? Personally, I think he's an intelligent man and he understands markets. I think it makes sense to not rock the boat. They're already shocking the market a little bit with the tariffs. If he were to double shock the market, that would cause a big sell-off. So it could be that A says nothing. I mean, there's kind of three scenarios on Wednesday. They do nothing and the market sort of breathes for another day. Or secondly, they do actually issue a lot more sort of long-term bonds, which would definitely tank the equity market and the bond market, by the way. And or the third thing could be that they sort of say, well, we're not doing it this quarter, but this is the plan in the future quarters. But you know how markets are. Markets always act very quickly and ask questions later. So I think that's still going to be negative. Now, the other issue as well is that Trump, I think over the weekend, tweeted out on Truth Social something like, um, what did he say? He said two things. He said the short-term pain of tariffs will be worth it in the long run. And secondly, he didn't care, quote, if the stock market had some short-term pain. And this is interesting because a lot of commentators always assume that Trump is fairly unidimensional and just, only is obsessed by the ES or the price of the SPY or something like that. But Trump's specifically saying that he seems to be prepared to take some short-term pain. And maybe they're thinking at the White House with Besant and Trump is like, hey, we've only got 2 years until we had the midterm elections. So they're kind of trying to go very, very fast. And you see the speed at which they're doing everything is extremely rapid. And who knows, maybe there's been an internal decision to kind of throw everything, the kitchen sink, all of the bad news at the market in the first week or two of the administration, let the stock market, tank a little bit. And then hopefully, within 6, 12 months, things will pick up and everything will get a lot stronger. So who knows? Maybe it's a specific policy that, they're going to throw on very aggressive tariffs. They'll keep the tariffs on. And yes, also the quarterly refunding announcement, they're going to term out the debt and actually issue more long-term bonds and just sort of give all the bad news to the market. And maybe we will have some kind of correction, which would be healthy. And what we're talking for that level there is 3%, and then maybe that level there is 6%, and then you go down maybe 10%. So I think, a 3, 6, or 10% correction is absolutely possible, depending on the combination of what happens with the tariffs and the quarterly refunding announcement. So the first thing I'd say is that, maybe some kind of long put call a put spread could be interesting, because at this point you've got to say, at these high valuations and in very extended multiples and whatnot, overbought conditions, plus the deep seek issue we had, it's going to be hard for the stock market to stay alive up here. Okay, let's look at a couple of specific markets as well. Other thing to look at here is volatility. We see here the VIX on the Friday trading around about 16.5. It's going to be interesting when the markets open. I would assume that just with the unknowns happening, that volatility will go up a bit. So those of you interested in maybe trading VXX, if possible, or maybe on options on VIX futures, I think, there's a possibility that this gets up to, maybe up to, 1950 to 20, something like that. And even we're going to have to see on the daily if it closes over, 2060 seems to often be a pretty key level. You see here, I've got it marked here. 2060 is often a key level. What would be disturbing if it gets up into the 30s? But I think there's a very good chance in the next 24, 36 hours that the VIX does go up, which again will be another headwind for the equity market. So let's keep a very strong eye on VIX and also the VIX curve. Let's just see if that VIX curve flips more into a backwardation, because as you remember, that normally the front of the curve in a stable and non-risky market is lower VIX than further out the curve, because not expecting any problems. So let's see as well if that VIX curve starts to go into backwardation and there's more premium paid for the very front of the VIX curve. So let's look at some of the currencies, because a lot of people are talking about obviously the currencies. So let's look at CAD, because that's obviously an important one. Just getting some, as we speak here, as I say, about 3:45 in the afternoon, we're getting some early cash markers. It looks like this is gapping up in favor of the US dollar, of course. So, probably we've got a big triple top up here. I think, let's have a look. Yeah, so we've got a big triple top. Very key levels here around about 146 or so. I think it's going to gap open up there, 146, 146.50. Which is nice because we had a straddle on this long US dollar kind of thing. So let's see where it opens up. But I think what's going to happen here is that we're going to sort of probably open up, a percent higher, 125 basis points higher. We may fluctuate up and down a little bit. But then really we're going to have to see what happens because if again by this deadline on Monday, so tomorrow night at midnight, if there's some kind of compromise, this could absolutely sort of come back pretty hard, 1% or two or three. On the other hand, if neither the Canadians or the Americans budge, and it looks as though, yep, tariffs are here to stay and that Canada's going to go into recession, the Bank of Canada may have to cut more aggressively. What we could then see is over the next, I don't know, a month or two or three, we could actually see the USD CAD grind, break this sort of triple top, go into 147, and maybe even grind up to 150 or even up to some people calling for 155, 160, on a 3 or 6 month time frame. On the other hand, if there is some kind of quick compromise, that for sure can come back down into the trade range. But absolutely, that's going to remain elevated. And again, it's most probably going to gap up at the sort of the 5 p.m. sort of official open today. Another thing looking at is the Mexican peso. I'm not an expert on the Mexican peso, so I'm not going to say too much. Something which some people are saying, though, is that Mexico is much more exposed and does a lot more business with the US in a sense, and of course with fentanyl and all this kind of stuff. So there's kind of more wiggle room. So who knows? Maybe the Mexicans are going to be more able to actually sort of cut a deal and make some compromises and show progress, which will keep Trump happy. So let's see how the Mexican peso reacts, but for sure it's going to gap lower compared to the US dollar. The other one, which is going to be very, very interesting, is the Chinese renminbi. So let's have a look at that. I'm going to go with the offshore, the CNH. Which again, very, very big level, big overhead resistance at 7.37, which is this line up here. I think it's probably going to gap open up here. But what's interesting, there's a couple of things here, is that because of the Chinese Lunar New Year holiday, we're not actually going to have a fixing until Wednesday. So on Tuesday night. So Tuesday night our time, North American time. Normally that's about 8 or 9 p.m. And as you know, that's a semi-manipulated or controlled currency. The PBOC sets a fixing rate, and they allow the onshore Chinese renminbi to trade within a 2% band. So it's going to be very, very interesting to see the fixing price on Tuesday night. And we won't have that for another couple of days. In the meantime, we've got the offshore, which is probably going to sort of jump around like crazy here. Pretty low liquidity, so that's a tricky one. But what's going to be interesting in terms of the Tuesday night fixing is just to see whether the People's Bank of China and the Chinese authorities want to send a message and fix it at a very strong rate compared to the US dollar and sort of symbolically basically say, hey, Americans and Trump, we're not going to allow our currency to weaken substantially, or whether they just sort of, let things work themselves out for 2 or 3 days. That's going to be super interesting. But again, we're not going to get an official fix until Tuesday night at about 8, 9 p.m. So that's definitely something to be looking out for. The other thing as well, Trump was asked about Europe. And I think he just said that he hasn't made an official policy, but he's saying that is the plan, is to on Europe. And for sure, probably like at least maybe a 10-15% tariffs on Europe. We see already that the Euro USD on the cash here couldn't get back in that big trade range at about 105. It was going down on Friday, and already getting reports that that's sort of gapping down lower, a percent or two. And you've got to say, if you look at the dovishness from Lagarde and the ECB last Thursday, there were a lot of the more hawkish members of the ECB over the weekend, people like Klaus Knot, who's the head of the Dutch central bank, all pretty confident, even the hawks, that inflation will get down to their target within the next 3-6 months. Very much worried about weakening growth. And now the added problem, which could slow down growth, of tariffs and a trade war. You've got to say that the euro against all the currencies is going to be weak against the US dollar. And for sure, it looks to me like the Euro USD can at least get down to 1.02. Should test that. Maybe it's going to bounce around a little bit. And then at some point, depending on what happens, it could even break this big level down, to around about 102. And maybe first stop could be down here at parity at 1, basically. I think as well, probably what's going to be attractive is shorting euro versus JPY. Again, issue here is that we've got a very big level here, 159.8. Let's call it about 159 on the euro JPY. That's probably going to gap down lower. it's not the most attractive entry point, but any sort of significant rally of a percent and a half, 2% on Euro JPY, structurally, you'd have to be thinking that's a short, because we know the BOJ, not that it's super hawkish, but at the end of the day, it seems to be less affected by tariffs. It is a safe haven. And also, we have a BOJ, which at the minimum is not going to be cutting aggressively. So you've got to be, any rally in Euro JPY should be a short. Similar kind of situation here with Euro CHF, which is the Swiss franc, of course. I've got to be thinking that this wants to maybe test down here. The only issue here is that the Swiss National Bank has been intervening. They definitely forecasting very, very low inflation. They don't really want the Swiss franc to appreciate too much to be to benefit from its safe haven kind of situation. So that's not the perfect one, but definitely a level up here. We probably won't ever see it for the next month or two or three, but if we get up to 95, that would be an extremely attractive entry point for a short on Euro CHF. Let's see where it opens up tonight. I'm assuming it's going to gap down. So that's just some of the currencies. I would also say that some of the trade sensitive currencies like the Aussie dollar, I'm assuming that that's going to be gapping down. We also saw that we had lower than expected inflation the other day. So from a monetary policy perspective, the RBA is probably going to be cutting at the first meeting of this year in February. And now there's sort of tariffs. There's no official tariffs on Australia at this point from the Trump administration, but tariffs on China and global risk off for trade is horrible for the Australian dollar, for sentiment, and often it's traded as a proxy. You can see already on the Friday this kind of reversal candle here. So you've got to say the Aussie is most probably going to gap down, and at a minimum here, testing down to 61.40. So again, it's just going to be a question if one is able to get some kind of entry point. Similar kind of situation here for the New Zealand dollar, but the Aussie, I think, definitely has, if it could break down there. I mean, where are we looking? We've got pretty big levels here at 61 and three quarters, 61.75. Probably is going to test down there, maybe fiddle around. But if the tariffs continue, and even who knows, maybe imposed on Australia directly, I think definitely that could be headed for a little bit more pain. And as you can see, we're getting to historically low levels. So in terms of other things, what is going to be an interesting one for me is oil. Okay, so oil, the actual structure of the market, I would say, is relatively balanced at the moment. I'm not going to go into too many details. We've gone into that. We have an OPEC a technical meeting on Monday and Tuesday. So tomorrow and Tuesday, I think we have so that's going to be interesting. Now, in terms of the Canadian oil, we know that there's going to now be a 10% tariff. So the heavy sour Canadian oil, which is used a lot by the Midwest refiners in the US, that's going to be more expensive. So the issue here is whether those refiners will kind of try and force the Canadian suppliers to cut their prices. And we're already seeing that West Canada Select is trading at an even heavier discount than normal to WTI. On the other hand, will we see that those refiners will eat some of their profit margins? Will we see that maybe gas, especially in the Midwest states, the price of gas at the pump is going to go up a little bit and be, at the margin, a little bit inflationary? So it's going to be curious here to see how oil reacts to that. Open at 6 p.m. We saw on Friday afternoon that on the news of the tariffs, that oil, the WTI, this is just the basic WTI contract, did actually go up in price. So this is going to be a tricky one. One could argue it should go up in price because at the margin, that's just going to make WTI oil a little more scarce, and therefore there should be a little of a premium. We shall see. It's probably not the best thing to be trading. Interesting here, but to be honest, we're long some call spreads here. I think it's an attractive entry level. I mean, you've got to be proved wrong fairly quickly here. So I think, if it does prove that WTI, does become a bit more expensive, and the Saudis and OPEC Plus, which has been rumored, are not going to increase their production on Monday and Tuesday, are not going to increase their production. I think this is an interesting level, at least to give it a shot for at least some consolidation, maybe at least going back for a fib retest up, $3 or $4, $5 in the $76, $77. That's that. Obviously, the dollar is going to be strong in general. We see a very, very powerful sort of uptrend pattern here. And to be honest, like the dollar index, I mean, you're looking here maybe something up to, I don't know, 109.26 or something like that. You're looking up to, let's have a look here, maybe up this level here, something like that. And if I look at a sort of Fibonacci extension here, like some kind of Fibonacci measured move, definitely you could see the dollar, first level up here, which is pretty important, is maybe 109.43, 45 up there somewhere. Then maybe a retest to the highs, and even the Fibonacci extension. Well, the first one is the retest to the highs at 109.90. But for sure, if Trump keeps the tariffs on, you've got to say what reasons would there be for it's a safe haven, presumably interest rates and the long end, the steepening of the curve is going to help the dollar and everyone else under pressure. It's also a case of the least dirty shirt, as they like to say, is the US currency. So looking at some other things, guys, gold, I think, is an interesting one. Let's look at the spot gold price here. Sorry, just sort of, where's my gold? Yeah, so there's the spot gold price. Uh, it's already sort of gone up a lot. I don't want to go into this now, but because of the tariffs, there's been a huge run up in the amount of physical gold which has been imported in the US to the COMEX, the COMEX sort of inventory kind of storerooms in New York, both for silver and gold. And I can actually show you this, and this is a bit of a weird chart. So just bear with me here for a second while I dig it out. Let's have a look. So the point is here that on the metals exchange, so what I want you to look at here, guys, this is, see here, gold inventory at the COMEX. So this is for the futures exchange, that physical gold. Look at this, guys. Since Trump came to power, and since he started talking about putting tariffs on metals coming in, so copper, aluminium, but also silver. And remember, silver, a lot of it comes from Mexico, and gold. Look at this. This is the amount of gold inventories held at the futures exchange in New York, COMEX, trying to front run and avoid, basically get gold into the country for delivery before Trump slaps his tariffs on. And this is interesting because what this is basically saying is that there's been a huge front running of gold. So that's pushed up the price of gold. And what you can also see, I'm going to do the same thing for silver at the futures exchange. Look at this, similar kind of situation. There's also been a huge run up in silver. So my question here is that gold, if you actually look on the futures price, so we're going to go back in here and look at GC1. Look at all this. Gold's had a huge run up in this period here. So my question here is, is this representing just like a short squeeze and traders making sure that they're not caught without having enough gold and not wanting to pay the tariffs? Or is this also much more to do with real interest rates and safe havens and all kinds of stuff? I think it's a combination of the two. What I will say, though, is that if you believe that tariffs at the margin are somehow inflationary, if you believe somehow that there's going to be trade wars, if you believe somehow that there's geopolitical tension, if you believe somehow that global central banks are buying more gold and allocating more assets to gold, I do believe that gold is a structural bid. So therefore, it just becomes a question of where one would maybe want to sort of enter. And I'd have to say that, maybe something like, I don't know, 27, 50, 60, if you look at the spot price here, kind of down, 27.20. This looks like a good price here. So I would get out your fibs. And I think any significant retracement is worth a shot, definitely, to be buying gold. And another way to look at that as well, just to sort of see how gold is performing, is, let's say, just look at a couple of ratios. And you see gold is doing very, very well here. So if we look at gold here, and let's say, divided by, let's say, just a basic sort of commodities like GSG, which you see here is commodities, you can see here that, gold is doing very, very well. And you see gold is outperforming the commodities and still is going. And who knows, can it break out even more here? So on this story of commodities, if you believe that global growth with trade wars, there's going to be a slowdown in global growth, maybe recessions in countries like Canada, you've got to say that something like gold with its other properties will quite possibly outperform, let's say, a general commodities kind of basket for sure. So that's something interesting to look at. The other interesting thing to look at, guys, just before sort of a stop here, is to look at some of these ratios here. And you start looking at, let's say, the stocks like SPY, and you're looking here at, let's say, something like IEF or SHY, so the front end of the curve. And again, you've got to say that the Fed will be looking at all this and thinking, whoops, are we about to get sort of a trade war and maybe a slowdown in growth? And maybe is the Fed going to start thinking at the first sign of any economic weakness of cutting? You've got to think here that maybe SPY versus some of these sort of short-term bond ETFs, not so much the TLT, could actually sort of settle down a bit, start going to the downside here. You see here already we're starting to see SPY divided by IEF going to the downside. So definitely keep an eye on all of those. Let me just have a think. Oh, the final thing I just want to say, guys, just looking at is over in Germany and Europe. So I just want to look at some of the German bonds here. And we know, we had the ECB cutting last week, and we know that Lagarde and other governors have been pretty dovish over the weekend, and maybe tariffs, et cetera, et cetera. You've got to say at this point, looking at some of the yields, that something like the front of the German curve. I'm going to bring up here, if I can find it, let's say like the 2-year yield. So this is the 2-year yield. Look at this already coming down. And I just wonder if something like the Schatz, so this is the 2-year yield, is kind of has peaked. And now as potentially Europe goes, even who knows, into like a trade war, tariffs, recession, and a very, very dovish protective ECB here, could we see more downside on the 2-year yields, maybe even like the 5-year? But let's just talk about the 2-year. And maybe this is like a bit of a safe haven here, is like the front of the curve over in Germany. And if you look at some of the differentials here, which you've got here, you're starting to see the differential. So for example, this is the US 2-year yield, subtract the German 2-year yield, and you see that pulled back. But now we're starting to see that the US yields compared to the German yields are actually starting to head up. And until we see the signs of sort of an economic slowdown or a slowdown in growth in the US, you've got to say that quite possibly the German yields will be lower, will sort of underperform from a yield perspective, the US one. So that's an interesting trade there. What could be interesting could be something like long German 2-year, short the 10-year in the US. Something like that would be quite interesting. Actually, I think I've got that here. Yeah. So this is interesting here. So this is like the 10-year yield in the US, subtract the German 2, and you see that pulled back. I mean, already, I don't know if it's been too late here. See, on Friday, it's starting to push up. And basically this idea here that the front of the curve in both economies, so the US and Europe, will be relatively stable, whereas the belly of the curve, especially in the US, will be under more pressure. And you can express that here by buying long Schatz, short US 10-year. But again, it looks as though that's pushed up. There may have a bit more upside to go there. I don't know if we've missed that by a day or two. Anyway, okay, guys, so I'm going to leave it there. As I say, just sort of general trades to think about. Obviously, any kind of sort of attractive entry shorting euro against really the safe havens, maybe JPY or Swiss franc. Maybe any, some kind of long call spreads on VXX or the VIX futures at some point, if possible. I also think equities with some kind of time frame of multi-week time frame, 2, 3, 4 weeks. Shorting those through long put structures could be interesting. I think things like the trade currency, Aussie dollar, could be under pressure. The front end of the European curve, let's call it the German Schatz, could be kind of an interesting one. And of course, looking out for sort of Canadian dollar and the Chinese renminbi. Although I think the Chinese renminbi, you are dealing with the Chinese government there as well. So there's a lot of politics and mixed up with that. Okay, I hope that was useful as a framework. Let's keep on talking and see you all guys on the other side tomorrow morning. Let's see how it go overnight. Thank you. Goodbye.